Welcome back to everyone watching our Bloomberg Markets report. Today I have three special guests for our edition on the signal and the noise. Very hot topic at the moment. Our first guest is Nate Silver. Nate is a maverick. He has been able to construct models that actually predict the reality, which is most than many analysts and economists can say.
Thanks, Julie. Let me explain the terms first. Signal is the actual information, whereas noise is generally everything packed around it. Randomness. Now the problem in finance and economics is that both have very noisy data and therefore most models fail to predict well. To give you an estimate, in general economists are wrong about 50% of the time. Majority of economists predicted growth for 2008.
This sounds ridiculous. How can they be so wrong? Markets always react to missed forecasts as though they were actual information.
Their major mistakes are that on the one hand they fail to incorporate in their models the out-of-sample events and their systemic implications. On the other hand they fail to communicate the uncertainty in their data and their models.
What do you mean by that?
Well, take the recent housing bubble in the United States. I see it as a failure of econometricians to understand the signal in the data and to change their models accordingly. The credit agencies didn't incorporate in their models the contagion of mortgage payers defaulting. They didn't look at the problem systemically, and didn't adjust their models to account for the compounded risks of the collateralized debt obligations. Then, most econometricians are uncomfortable with uncertainty. No econometrician would be happy to say there is a 40% probability that a negative outcome will happen. There is a joke about statisticians that if they put one foot on a stove and the other in icy water, on average they should feel well. See, that is exactly the problem of econometricians. They are fond of giving the summary data rather than telling you the uncertain possibilities. This leaves you worse off.
Thanks for this introduction, Nate. It was great. This also gives us the tools to talk to our next guest from finance, Mr. Jan Hatzius, Chief Economist at Goldman Sachs. He is one of the best econometricians. He was warning investors back in November 2007 that a recession was underway. Now, Mr. Hatzius, tell us, what are your secrets?
Julie, thanks for inviting me. First of all, let me be honest with you. We all know very little about modeling. I have done better only because I look at things differently. You see, there are three challenges that economists and financial analysts face. One, it is very hard to determine cause and effect as the economy is always changing. An assumption used in one business cycle may not hold in the next. It is also tricky to identify real causes and to distinguish between correlation and causation. Secondly, identifying the signal is really hard. Variables that are leading indicators in one economic cycle turn into lacking ones in the next. Like consumer confidence, you never know whether it is indicative of a recession or it has been caused by it. Then you have the built-in assumptions, which are based on low volatility history, but they are used to predict largely volatile times.
So it is really hard to estimate anything at all.
Well, yes. The problem with modeling financial conditions is that the signal changes, and then you have to change the model. You can't rely on government data either, as it is often mistaken.
Then what is the secret to your success in modeling?
I work out a lot. No, I'm kidding. I believe it is important to understand the economy. The story behind the data, the cause and effect side of things. If you start from raw data instead, without any underlying structure, you are likely to mistake noise for signal and interpret correlation as causation.
Thanks very much, Jan. Next we are turning to Eugene Fama, who has developed a theory very much related to the signal and the noise.
Hi Julie, thanks for having me. My hypothesis is that the market is efficient and no one can predict it. If you detect a signal, chances are other investors will too, and it will begin to cancel or reverse.
But this is not what happens in the markets, as prices move all the time.
Yes, noise traders are causing noise in the short term, but they also create liquidity, making trading possible. The stock market is like two processes in one. There's the signal track, the stock market of the fundamental prices, and there's the fast track, the noise track, full of momentum trading, positive feedbacks, skewed intentions.
Thank you. You have seen today three perspectives on signal and noise. If there was something important to take with you in terms of building models, It is probably the healthy skepticism towards yourself and the assumptions that you build in your models. Don't forget to revise them all the time in the light of new information, by considering all of its systemic implications, and don't be afraid to incorporate uncertainty. Thank you for tuning in today. See you next time.